Good morning and welcome to this Thursday, August 10th, 2023 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes as we take a look at what's transpired this morning and what we can expect later today. First, big news, Thursday, July CPI report came out this morning, and it came and went with a whimper. Really just exactly what the market was expecting. That both the headline number and the core number came in with a rise of 0.2% for the month of July. Still have the PPI number coming out on Friday, but I think that CPI number is the one that is probably most important to focus on. I think that's the one that the Fed will focus on primarily. And again, that number came in pretty tame, really what we were expecting. And the annual core inflation rate actually dropped just slightly below expectation from 4.8% to 4.7%. So it's still not 2%, but it's also not over 6%. We are heading in the same direction that we want, to the downside. And the history of the stock market is when the inflation rate drops, when it peaks and starts to roll over, the stock market does very well. And that's what we've seen here in 2023, really starting in the middle, I would say, of 2022. Let's go ahead and jump in and take a look at the action from yesterday. So the Dow Jones Industrial Average finished down 191 points. That was a little more than 0.5%. S&P 500 down 32. That was 0.7%. And once again, we saw, unfortunately, we saw the NASDAQ lagging, down 171 points. That was down about 1.1% for the day. Mid caps down about 0.5%. Small caps down about 0.75%. So again, the NASDAQ, we're seeing that rotation consistently away from the NASDAQ. We tested the 50-day moving average yesterday, which is what we look for after negative divergences print. We got it on the NASDAQ 100, as you can see right here. Not only a 50-day test, but look at the PPO. Quickly moving toward that zero line for a potential reset. And so what this tells me is that, which way are we going to go? Sometimes these daily negative divergences can be a precursor to a down market. Market goes down for a while. Or it can simply just be a reset where the momentum kind of gets ironed out. The momentum issues get ironed out over a period of time. In this case, really started the middle of July. So we're on our way now for about the fourth week to the downside. I usually say 1 to 3 weeks. They can, be ironed out. This one's a little bit longer. And we're also in the middle of August. And we know not to expect a whole lot from the market during the months of August and September. So I think we're probably going to do more consolidating from this point, more than selling. We could certainly go a little bit lower, and it's very difficult to call the market in the short term, day to day. But I do like the longer term. Nothing has changed. I'll show you a chart of the day today, which I think is pretty interesting. I think you'll find pretty interesting. And it revolves around the rotation that we've been seeing in the market. But the recent rotation might surprise some of you. So we'll take a look at that in just a minute. But again, overall market continuing to drop, but nothing horrible. We saw a lot of the weakness again in the morning yesterday. Had a big rally, looked like here we go again. We're going to turn this thing around. And then we saw some selling into the close, probably ahead of that CPI report, I would imagine. Transports continuing to fall a little bit here. So we did pull back, tested that 20-day moving average, actually closed about 20 points beneath it, 16,170. The 20 days at 16,191. And with a little bit of negative divergence in play here, this is another one that potentially could go down to the 50-day. We have a lot of that where we could see 50-day tests. And if we see more and more of these companies, or not companies, but indexes testing 50-day moving averages, it's going to be very difficult for the overall market to go higher. I mean, we could now see something like technology. If you look down here below at the sector performance yesterday, energy was the leader, up 1.26%. You can see energy doing very well right now. Technology moving in the other direction. But we've gone a little bit below the 50-day moving average. Look at that PPO. It is now down to the zero line. It actually is slightly in negative territory. First time we've seen that in the last 6 months, and probably since back in January. I'm not going out that far here, but it was probably January since we've seen that PPO in negative territory. So that's certainly something different that we haven't had to experience in 2023. But as you start to see groups like that have pulled back, if the market truly is going to go higher and we're in a secular bull market, I think we're going to see traders start to look at technology as an area that they may want to start to get back in again. So some of the areas of the market within technology, some of the stocks within technology, where you've seen negative divergences play out down to the 50-day moving average, I think those are some of the plays that probably would make a lot of sense to me right now. I think those are stocks that could bounce back and could bounce back quickly. Although again, I kind of lower the bar, the expectation bar in August and September, just because what we know historically. Discretionary weak yesterday as well. We already had, pretty close to a 50-day test just about a week ago. But we were weak again yesterday, down about 1.2%. And watch that recent low in the 50-day moving average. Those would be the two areas of floors that I would be paying attention to. Within the industry groups, semiconductors. Remember how strong semiconductors were? They were absolutely scorching to the upside. Well, they have now lost their 50-day moving average, like technology, actually leading technology to the downside. So this is a group that we want to be a little bit more careful with. 50-day has been screaming higher. After this huge move to the upside, I think we could bounce off the 50. I think we'll probably look for key support levels on the semiconductor index, and I would be looking maybe down around 9,300. I think we still have potential downside to that area, but we were at 10.5 and now we're at 9,600. So as we fall further and further, a lot of the risk, in my opinion, is coming out of that area of the market. So individual stocks within that area that you like, that are leaders, that have pulled back, they could be, very interesting long candidates. If not today, certainly over the next few days. So I'd continue to watch that. Automobiles dropping below the 50-day moving average. Once again, look at that PPO. We have now gone into negative territory, down 0.98. So autos showing a little bit of wear and tear after their big rally to the upside. In this case, watch price support. I was talking to members yesterday in the trading room about, when you lose 50-day moving averages, one of the questions that came in at the end of the trading room is that kind of like, hey, get out because you're below the 50-day? And my answer is no. The most important technical indicator, in my opinion, is the combination of price and volume. So 50-day moving averages, 20-day moving averages, PPOs, trend lines, all that stuff is secondary. The most important thing is the support area on a chart, price support. So I look at the most recent low, and that would be where I would start on almost any chart. Recent low was at about 860, maybe 850. And that's about where we are right now. So yes, we're below the 20, we're below the 50. The 20 looks like it's about to cross below the 50. But I think in order for the bears to continue driving autos lower, you're going to have to lose that support level. And maybe it's going to happen. Then you got another support level coming in closer to 800. But 860 down to 800 would be, probably about 70%-ish. 7%. I don't know if I said 70, but 7% drop to the downside potential if we fail to hold that recent low that we saw in this group back in June. Airlines, remember yesterday I talked about what a great jump that was to the upside, nice little bounce, could be starting an uptrend. Well, yesterday was back down almost 2%. And this is one of the reasons why it's really difficult, in my opinion, to trade individual stocks, because we've been seeing this kind of whipsaw, maybe not quite to that degree, one day, one of the best, next day, the worst or one of the worst. But we have seen a lot of volatility, a lot of movement back and forth. And it's why I continue to trade mostly ETFs. Let's move on, take a look at the 10-year Treasury yield. So again, today we had the CPI came out better than expected. Well, I won't say better than expected. I think the core CPI was better than expected slightly. They both, came in at 0.2% rise, which was what was expected. but the reports that we get are rounding. They round the numbers. And so I actually think that the actual number was a little bit lower because the annual rate came in below, even though the monthly rate was the same. So that doesn't really make sense for the annual to change and go down unless there was maybe a rounding that took the CPI up to 0.2%. So I think that inflation continues to remain, I wouldn't say remain in check, because that's not, we weren't in check to begin with. We were obviously rising and up over 6%, but we are moving back in the direction that the Fed wants. Whether it's the pace that they want, when they combine that report with other things like or the CPE, CPE. I don't know. We're going to have to wait for the Fed to tell us what they see and what they're going to do. I'm looking at 10-year Treasury yield, which has been trending higher over the course of the last few months. But here in the last week, we've been trending back to the downside. Is that just temporary? Do we move back to the upside? I don't know. One thing I will say, though, is on this chart, as the 10-year Treasury yield has been rising, what we typically see is strong relative strength in financials and industrials when that's the case. And right now, we've been seeing financials trending higher for the last 2 months, roughly. Industrials, maybe back the last 2.5 months. So while interest rates are going up, we are seeing that more normal behavior kind of following suit. So these are two areas, financials and industrials. If rates keep going up, or even if they just kind of trickle a little bit higher, I think you could see continuing outperformance in financials and industrials. All right, let's take a look at some of these charts of our major indices. So here's the S&P 500. And anytime you're looking at any chart, whether it's a 10-minute chart, hourly chart, daily chart, whatever, you can always move out and look at a bigger picture. And so sometimes we get caught up in just whatever we tend to look at. And for me, that's the daily chart. I want to show you, and I probably have done this before, but I still want to show you how strong our major indices are on a weekly basis. So the daily, even if we do break down in the daily, and again, it's August, September, I'm not ruling anything out. I think we could still go down 3-4%. I wouldn't be surprised. But that's because of what I'm expecting in terms of on a weekly chart, where I expect major support to be. And that first major support would be the 20-week moving average. Normally, when we have a PPO that is this strong on a weekly basis, and we have a trend up above the 20-day, which is above the 50-day, that 20-week, which is above the 50-week moving average, that 20-week moving average has typically, historically, been critical to the downside. That's where we see a lot of major turns in, I would say, maybe the more intermediate term rather than short term. Daily charts, I consider still to be short, maybe to slightly intermediate. When you get out to the weekly charts, I start thinking intermediate. And so watch on any weakness, watch that 20-week EMA. All right, let's move on to the NDX. All right, sorry, I think I got a little, I don't know, some kind of a allergy maybe. Anyway, the NDX has hit that 50, the 50-week SMA, as you can see on the chart. So this is an area I would actually expect to see the NASDAQ 100 turn, because we are down into an area where we've seen some support. I actually thought maybe right around the 15,200 level would hold. We went a little bit below that, but we do see futures bouncing back today, which is one thing actually we didn't talk about. I do want to show you what futures are doing, or see if they're still doing it. So I usually come in before the market opens and I just look at the major ETFs. So the diamonds are up roughly 0.6% this morning. The spider up about 2/3%. The QQQ up almost 1%. And we saw an immediate jump, and we saw a pullback after the CPI number came out. And then we had another big rally where we're in the midst of one. So it looks like we're going to start off pretty good. The small caps, small caps up about 0.5% right now. All right. So let's go on to, let's talk about the IWM there. So I had a member question that came in asking about how I'm trading the TNA, and the TNA, actually, hold on 1 second. All right, sorry about that. Trying to get rid of this frog. Anyway, the IWM, this was a question that came in from a member, and it's a valid question. A couple of days ago, I had indicated, this would have been back on Monday. I indicated that if we went below 192.25 on the IWM, that I was going to be moving out of the TNA, which is the leveraged ETF. And when I talk about moving out, this is going to answer actually two questions, because another question said, is there a time when it would be appropriate to own both the IWM and the TNA? The TNA tracks the IWM at a 3-to-1 clip. I mean, that's what I generally have, is both of those. Normally, when I think we're going to pull back, I don't want to be out of the market. I believe we're in a secular bull market, even though we're going through September or August and September, and I know we could pull back some. I don't want to be out of the market because I don't want to miss the move to the upside that I believe is coming. I think we're going to go right back up to new highs. And on the IWM, that would be a really exciting next breakout above 198, 199. We start seeing a two handle. I think that would be a very significant breakout on the IWM. And I don't want to be out of the market. So the question for me every day is, do I want to be in the TNA, which is a leveraged ETF, or do I just want to be in the IWM? And that's normally what I'm doing, is just, it's kind of like, if you think about Wall Street firms and the way they do their allocation, you know, it's like, okay, we're going to be 60% stocks, 25% bonds, and 15% cash. And then they may reallocate and go 65% stocks and maybe 20% bonds and still keeping 15%. Or maybe they, you know, go up to 70% and just lower their cash level because they're getting more comfortable with stocks based on wherever they're valued at. Well, I look at the IWM and the TNA in much the same way. I'm looking at it thinking, I want to be in 100%, but when I think the IWM is down to a key support level, or maybe it's a major breakout, that's when I want to consider being in a little bit more. I want to take a little bit more risk and move into the TNA, which is the leveraged part of the Russell 2000. So when I said the other day, I was like, I'm going to keep an intraday stop on the TNA. What I would do is, if I got out, number one, I would move back into the IWM. It's just getting rid of the leverage. It's not exiting small caps. And I try to be pretty clear with that, but obviously if one member has a question, maybe some others have questions as well. So the question that came in though is the next day when we opened down at, 190, 192, might have even been a little bit below 192. And we quickly in the morning traded down. The question was, did that stop me out? And my answer is no, it didn't. I had an intraday stop on Monday, but we never hit it. And we looked really good into the close. I love that long tail below the 20-day and closing back above it. So there's no way I was getting out on that candle. So I was in it the next morning when we had obviously the gap down. And at that point, I have to reevaluate. Number one, I know mornings have been weak and I know afternoons have been strong. I wasn't available to jump out right at the opening bell because we had, I had the show which went over the opening bell. And by the time I started looking at it, I had to prepare for a live trading session yesterday. And I'm looking at it and the IWM is dropping. And what I'm looking at is this support level, which I think is the 20-day moving average, or was the 20-day moving average. And then I'm looking at other support levels. We have gap support down at about 189.75. And then we had this double top that we broke out of at around 188 or 188.50. So when I looked at it in the morning, I'm now looking at it and there's almost as much room to the downside as there is back to the upside. It's like I'm between the two major moving averages, or the two major support levels that I'm looking at on the IWM. So at that point, if I could get out up here as it trades down below the 20-day, I feel like I can save some money by moving into the IWM and then moving back to the TNA when we hit the next support level. Unfortunately, I didn't have that opportunity yesterday because, again, when the show ended, I usually run a little bit over 9:30. And when first time I looked at it after I finished the show, it was already down. I mean, I think if we look at the 5-day moving, or the 5-day 10-minute chart, this is what I was looking at yesterday. So, I mean, within the first 5 or 10 minutes, by the time I looked, we were already down below the 190 or into the 191s. And that to me was kind of in nowheresville. I mean, I didn't know if, we started to rally back. I'm like, okay, here we come back to the upside. This is actually going to be an up day. And then I just kind of got stuck in the middle, which happens sometimes as a trader. And I'm still looking to evaluate my risk. And I just, said, hey, I'm going to hold it. So at this point, I have no plans on exiting, even on an intraday basis. We'll see where we close. To me, the biggest number on the chart, I can give you that number. And, if we break down below this, I'm not going to say it's over for small caps. I think that would be a little premature, but it is telling me I need to be careful. And to me, that means taking out more risk, not putting more on. The candle bodies that I'm looking at here, 188.32 is the open on June 14th and 188.26 on June 30th. So both of those opens, I look at candle bodies, that's telling me right around 188.30. I need to, pay attention on a close below that level. The 50-day moving average is at 188.45. So all three of those, that is major support, 50-day and key price support. So at this point, I'm going to hold on. And as long as the IWM stays above that, I'm going to stick with what I have, because I'm ending up taking more risk than I wanted. But at the same time, I now have the reward, not just to 199, but if we get back to 199 off of this pullback, and I think we're kind of tracking or testing this trend. Let me get rid of this and just quickly annotate this. So even if you connect where our close was yesterday and kind of where we were a couple months ago, 2.5 months ago, you can see now we've had tests. And the thing with trend lines is they're very, very subjective. And you always need to be aware of that. And what I mean by that is you could draw from the intraday lows if you wanted. And you can see if we connect the intraday lows from back at the end of May and again in early July, we haven't quite reached that level. And if I look at the most recent support, price support and gap support, it comes in right at about that level. I mean, there's your gap support right here. And then that price support on that low is right about there. And so if you notice, these two come in almost right on the trend line. And if you go down to the price support that I'm watching, if we go below that level, we'll lose the price support, we'll lose the 50-day moving average, and we'll lose this trend line. So to me, that's why I think it's the bigger support level, because if somebody's looking at price support and it goes below, they're going to sell. If somebody's looking at the trend line, they're going to sell. If they're looking at the 50-day moving average, they're going to sell, because we're below all three of those levels. Here, what we're talking about up here, we've got, and let me get rid of the lines again. All right. So here we've got the trend line that we're approaching. We are below the 20-day. That was the first step. I mean, technically we had a negative divergence. If you look, that last price high right there did come with a slightly lower negative divergence. So it wasn't nearly as, pronounced as the NASDAQ's negative divergence, but there was a negative divergence kind of similar to the S&P 500. So there's definitely a chance we're going to go to the 50-day moving average, even with the strength that we're seeing in pre-market this morning. I wouldn't just say, oh, the inflation report's out, we're looking up in pre-market, therefore we're going to go higher from here. We could, but like I said, short term, very difficult to call, but there are some key levels I think are important to watch. And that's why that 188.25, 188.30, right in there, I really don't want to see a close below that level. All right. Sorry, it took a long time there, but when I get questions from our members and they're trying to understand kind of the way I'm thinking, the next day to me was a completely different day because we gapped below the 20-day moving average. And at that point, you got a different, you got to make adjustments as a trader. You could say, well, just sell and get out and wait and see. I felt like we were already down so much in the morning yesterday, and knowing the way we rally back in the afternoons, I didn't want to get caught in that whipsaw where I get stopped out at the open. I really don't like being driven lower or driven out of positions by market makers, which I think happens a lot in the morning. And so that was the reason why I held. We got the rebound yesterday. We came back down again. Today, we look like we're going up. I'd like to see us get back up and sustain a move back through the 20-day. That would be
Tom,
short-term bullish. Yeah.
I think you're not streaming your screen anymore. It stopped streaming for some reason.
Oh. I've been talking a long time too. That stinks.
Oh, it's only been for 1 minute or so that it went down. You should be good though.
Okay. That's weird because I didn't stop the share. I don't know why it would have, or maybe I accidentally clicked it. I don't know.
Yeah, that was weird though.
Yeah, there's the trend line I'm talking about. Here was the tops. I don't know how much you saw whether you saw those lines, but gap support, there's your price support. So if you lose the 50-day moving average and all those levels, I just think I'm still going to be in the IWM, but I'm going to be out of leverage if that happens. Because I don't want to be caught in leverage 3 times as the market comes down and loses key support levels. All right, moving on. Transports. All right, I am getting some weird stuff. I don't know. We have some. I've heard thunder, so I don't know if maybe the storms are doing something or not. But anyway, transports did close just slightly below the 20-day moving average. This one's kind of hard to see if there is a negative divergence. If it is, it's very mild. And I don't expect we're going to go all the way down to the 50-day moving average, but anything's possible. Here was a recent high. That was the February high that we cleared and really never looked back. And so that comes in probably at about the 15,700 area, which could be another couple percent to the downside. And then maybe from that level, we see a recovery. But that would still be a pretty big drop to go down to 15.4 and change. All right, let's talk a little bit about EarningsBeats because I want to show you a chart that I think you're going to find somewhat fascinating. But if you like these charts of the day, scroll down at our website, EarningsBeats.com, and just hit that or look for this box where you can put in your name, email address, hit that subscribe button. We'd love to have you. 3 times a week newsletter, Monday, Wednesday, Friday. Try to make it educational. Hopefully it's something that you enjoy reading every day. Also, if you're a member or if you're a subscriber of our free newsletter, any free webinars that we do, we reach out to that community. So a couple of reasons there to be involved. So let's take a look at what chart I wanted to show you. I've been showing this to members quite a bit. I bring it out on here every once in a while. And I could probably stretch this out a little bit to make it maybe a little easier to read. Let's try this. Hopefully it doesn't skew all my annotations. It could. No, I like a little bit. Let's go back to that 1100 chart. Okay. So I've talked a lot about the IWM, and when you look at the IWM relative to the QQQ, so it's the Russell 2000 versus the NASDAQ 100, you can see we've been rallying. This is just simply taking the IWM versus the QQQ. This is what you're going to see. If you pull it up just like that, IWM colon QQQ, this is what you're going to see. And I used a line chart here. So we're trending higher, which means IWM is outperforming. But if we get rid of the gaps, because I believe that there's a lot of manipulation that takes place, not only at the opening bell, but also into the early action. And so if you take that out, look at how strong the IWM is versus the QQQ from 9:30 to 4 o'clock. I've been talking about the IWM, how it's been very weak in the morning and then comes rallying back. Well, it's doing it a lot better than the QQQ. And that's how it shows up on this chart. This is actually a chart that I developed. So it is unique just to EarningsBeats. We share it with our EarningsBeats members and with all of you from time to time as well. And this is just telling me what I've been seeing, which is rotation away from some of the more aggressive groups and into some of the areas that did not participate as well earlier in 2023. And so this is one of those reasons why I'm really bullish the IWM. I think we're going to make a run. We're going to break out above 200, and I could see us at 240 by year end, which would be another more than 20% from where we are right now. I just think that the next leg up is going to be led by small caps based on some of these things that I'm seeing. So that's, just one more piece, I guess, to add on to that IWM story. All right. I wanted to talk, I know it's 9:30, it's just a little bit past 9:30, but I wanted to just show you real quick. If you like to scan, you can write your own scans, but one thing you can do is actually down here under scans, I can find it. So if you go down to your scans, and if you don't see this on your dashboard and you're a member, go over here to the gears, click on this and see what's checked off. You probably don't have scans and alerts checked off. So make sure that's checked. And then once you check it and come back, you should see your scans. But here under the more, if you click on that, you'll see this predefined scans. So if you're not really comfortable writing scans or you don't understand how to write them, and so you just don't trust yourself, there's a lot of predefined scans that Stock Charts provides you. And so you can get these bullish MACD crossovers, which would essentially be the same as a bullish PPO crossover. PPO and MACD very similar. You could also come down and see the bearish MACD crossovers, how many you get there. And one really cool feature of this is if I go in and look at this bullish crossover, because I don't know how to write the scan. Well, let's pull up these 8 NASDAQ stocks. Actually, it's not there. Let's look at this bullish MACD crossover. There. Oh, okay, here it is. They moved the box. So here you can go in and edit scan criteria. So if you don't know how the scan was written, click on that. And there it is. You could make minor adjustments to it if there's something in here. Let's say you didn't want, OTC bulletin board stocks. You're not interested in those. You could get rid of those. And if you want the 20-day, the daily average volume, maybe you want the 50-day average volume, and maybe you want it to be 250,000. They've already written the scan for you, and all you do is just go in and adjust what you're looking for. And then you can kind of watch and learn a little bit by reading how they're, writing the scan. It'll help you learn to write the scan your own scans a little bit better. So this is how I got started with scans. Actually, I came in here and I just saw how Stock Charts wrote the scans and started practicing doing some stuff on my own. And I'm by no means an expert over there. I can tell you Bill Shelby is the expert over at Stock Charts. And we've had him on some of our shows and so forth, but I'm dangerous with the scan engine. But anyway, if you just wanted to make those couple of changes and then run the scan, there were 27, now they're 19. So you eliminated 8 that you just weren't interested in, low volume or over the counter bulletin board stocks, which I have no interest in personally. I just don't think that I don't see that the overseeing board or what, I just don't think that they watch those companies. I think they, could have, I'm not going to say funny business, but anyway, I just don't trust the numbers. I'll just go there. So I stay away from the over-the-counter bulletin board stocks. But that was just a quick way to take a look at the scan engine and maybe get a little bit better. Pull up a scan, one of the predefined scans that you're interested in, and you may just use that scan, or if you wanted to learn more about it, make sure you click on that blue edit scan criteria button, and then you can pull it up and mess around with it and maybe learn a little bit more about the scan engine. Here is the upcoming earnings. This was actually the one that could have been used yesterday. So it's just showing you all of the stocks that reported the night before last or yesterday morning and how they traded once that data and all that information was out there. And you can see some of the areas. Got 2 of the top 4 in healthcare. You did have some communication services in here that did pretty well. And if you flip this, you can take a look at what wasn't working. I mean, 5 of the top 8 stocks were technology stocks. One was software. Pubmatic down 33% yesterday. And then if you wanted to go further and take a look at the charts, you could see obviously it was much better, and now it's all the way back down near the recent lows. And today, since the market is open, we've been open for 6 minutes. I thought we'd pull up today's. So I'm going to refresh this page. This is, Disney Trade Desk. If you go through these chart lists and you sort it in name order, it's basically an order of market cap. 0001 is the highest market cap company that reported yesterday after the bell. And if you come down starting with 1001, Alibaba, that's the highest market cap company that reported this morning. But they're both getting their reactions today because they reported since the close yesterday. But anyway, that's one way you can just see how big these companies are in terms of market cap. But let's go ahead and update this so we can see what is actually working and what's not working. Magnite software company down 33%, back down to $8. This company was actually starting to show some really good strength recently. Nice uptrend, broke to a 52-week high. And now in less than a week, we've gone from 15 to 8. Below these price support levels, of course, this is still intraday. So maybe we go down, maybe we hit this gap support level, and then we start to turn. That was a lot of volume. We saw a lot of buyers come in at that level. That price, just to give you an idea, would be at 720. So if we keep selling off and we go down and hit 720, you could see buyers come in simply because that's where buyers came in for that earnings report. A lot of support probably around that 720 area. Looking at the next one, so Task not doing well, Plug Power not doing well. And again, 3 technology names right at the top. What is working today? What earnings report looked pretty good? Here's 2 software stocks right near the top, up 23%, up 13%. Let's take a look at that top one. AppLovin, big gap up, but when everybody buys at the open, a lot of times market makers are on the other side and we see the sell-off. So you can use this in a lot of different ways, but I love these upcoming earnings chart lists. All right, and of course, taking a look at Disney, that was the big one. Gapped up, pulling back, still up a little bit, up 1%, but yeah, still got some work to do. That 85 level, I think I pointed it out maybe in one of the daily market reports recently, as Disney got down close to a key support area. If you are big, I would worry going into an earnings report, you could get a big gap down and lose that support because it hasn't been a very good performer. But I like the fact that we had a gap up on Disney with its earnings report. It tells me that it's more likely than not going to hold its support level if it goes back down near 85 again. All right, I went quite a bit over here, but let's take a look at what the market's doing here early on. So you can see we've got Dow up 0.9%, S&P up 8.8, NASDAQ 0.98. So we are off to a really good start there. Small caps lagging a little bit right now, but they're up as well. And we've got the VIX down about 7%, back down below 15. So we're up in that 17 area. Thought we might head up toward 20. right now the VIX seems to have other thoughts, heading in the other direction. Big down move so far today. Here we were up over near 17 yesterday around noon, and you can see down quite a bit since then, about 2 points on the VIX. Anyway, that's it for me. I appreciate everybody tuning in. I'll be back on Tuesday for the next Trading Places Live. Sign up, try our service, try our EarningsBeats Digest newsletter. I think that's a great way to get started. And if you want to try our paid service, 30-day free trial. If you go over to EarningsBeats, right here, just click on that green button. We can get you set up. You can enjoy our trading rooms for the next 5 weeks, or well, I guess next 4 weeks at this point. And a lot of other great stuff, great service that we offer to our members. So check that out. If you are new watching on YouTube stream, our live stream, please click on that like button. That helps us. And also be sure to subscribe to our YouTube channel and turn your notifications on. If we have events and we share it live stream like this, you'll be notified and you can join us. So anyway, love to have you. And thanks again for watching. Have a great day, everybody. Happy trading.